Blue Label Telecoms expands stake in CellSAf by settling telecom operators' debt. Blue Label Telecoms, a major player in the South African telecommunications industry, has strategically increased its holding in the mobile operator CellSAf by another 10%. This acquisition was facilitated through its subsidiary, the Prepaid company, TPC, which settled CellSAf's outstanding debt to Dark Fibre Africa, DFA, in a creative exchange of assets and liabilities. DFA, known for its extensive open-access fiber infrastructure across South Africa, plays a crucial role in the telecommunications industry by providing essential infrastructure needed by mobile and fiber network operators, including CellSAf. The interaction between these entities highlights the interdependent nature of modern telecommunications infrastructure development. In a detailed disclosure, Blue Label Telecoms revealed that the transaction involved transferring the debt owed by CellSAf to a specially created vehicle, SPV5. This was in return for a 10% shareholding in CellSAf, which now forms SPV5's sole asset. Furthermore, TPC committed to a significant financial arrangement where it would loan SPV5 a total of R275 million over 2 years. These funds were earmarked specifically for settling the debt to DFA, thereby ensuring that all parties' financial interests were safeguarded. Once the debt was settled, SPV5 secured 10% of CellSAf's share capital, which it then provided to TPC as a form of security against the loan. The structure of this deal underscores a meticulous approach to corporate finance and asset management within the telecom sector. In terms of future financial arrangements, SPV5 is obligated to repay TPC from any future sales of shares or dividends, alongside a substantial additional claim contingent on the economic performance of its holdings in CellSAf. This acquisition not only increases Blue Label's economic interest in CellSAf to an effective 73.19%, but also demonstrates a strategic pivot towards consolidating its investment in the telecom company. This move is anticipated to have significant financial implications for Blue Label, as part of this transaction has been equity accounted, reflecting a nuanced approach to handling its expansive telecom investments. Furthermore, the agreement stipulates that SPV5 cannot sell its shares in CellSAf without TPC's approval, indicating a protective measure to maintain strategic control over the telecom operator. However, it's essential to note that any potential default could lead TPC to acquire the 10% shareholding directly, albeit with necessary regulatory approvals, potentially giving it full control over CellSAf. This transaction has advanced through various regulatory hurdles, with approvals from both the Independent Communications Authority of South Africa, ICASA, and the Competition Commission. These approvals are crucial as they ensure that the acquisition adheres to national competition laws and telecommunications regulations, reinforcing the legality and appropriateness of the transaction in the broader context of South Africa's economic landscape. In conclusion, this transaction not only demonstrates Blue Label Telecom's robust strategy in strengthening its market position, but also highlights its innovative approach to managing and structuring its investments in the competitive telecommunications sector. Thank you for choosing Satori News.